Where are the bond vigilantes? Are they back?
They are in hiding currently.
Mark Trevarthen, welcome. What's at the heart of this bond bear market?
Yeah, David, so it's been a very interesting period since the invasion of Iran. We've seen a huge spike in energy prices, which has really forced everyone around the world to reassess the outlook for inflation and also growth. Right now, the markets are laser focused on the inflation side of that equation, and so expectations for interest rates have changed quite significantly.
Well, and absolutely to the upside. Now, the last time the bond market got a bit yippy, as the US president put it, the language from the White House really calmed the market down. How close are we, though, Mark, to being back at that sort of market environment?
Yeah, good question, David. I think we're very, very close. I think Trump is particularly focused on long-term bond yields. They're very much a driver of borrowing costs for the average US homeowner. And they're also the price of money. The US has a huge debt burden, and he can't afford to see long-term borrowing costs spiral out of control. So I think we're very close to a point where Trump needs to rein that in and take action. Certainly he changed his narrative overnight, as recently as in the overnight session, when he softened his rhetoric towards Iran. That sparked a little bit of a reversal in the bond market, which in turn sparked something of a reversal in equity markets as well.
Where are the bond vigilantes? Are they back?
They are in hiding currently. We're certainly we're hearing a lot, certainly in the media, about spiraling bond yields. For many, many years we were enjoying zero yields and actually negative yields in many parts of the world. The post-pandemic inflation shock caused a big change in the landscape for yields, and I think this recent spike in energy prices, has brought them all out of the woodwork again. So it's a narrative which is not going to go away. We foresee ongoing volatility until the crisis in the Middle East is resolved, but ultimately, we think that this resolution will result in slower economic growth and some stabilisation for bond yields further down the track.
Well, that is further down the track. What are rising bond yields now, especially at the longer end of the curve? What are they telling you about the future direction of interest rates more broadly?
Yeah, so they're certainly an indicator for inflation expectations. But let's also remember that rising bond yields can also be a good thing. They can be a reflection of strong economic growth. I think the commentators around the world have been very surprised with the robust economic growth that has been exhibited by not only the developed world but also emerging economies in the face of higher interest rates in the post-pandemic world. So whilst it is an inflation issue in the near term, we're also enjoying growth rates that we perhaps would not have expected to see in the wake of higher for longer interest rates post-pandemic.
Mark Trevarthen, we've got the US 10-year government bond now around about 4.5%, flirting with the idea of 5%. How high does that global benchmark risk-free rate need to go before share investors globally are really spooked?
That's another good question, and I think we did briefly visit 5% a good 2.5 years ago. There was a momentary flirtation with that level in the US 10-year. It was met with a lot of buying, and so we rebounded quite significantly off that level. I think that, as is always the case in my time in the bond markets, if the move is orderly, then we can expect equity markets will largely absorb the higher borrowing costs, and they will take it in their stride. If we have a disorderly, perhaps a deleveraging situation in bond markets, then we're likely to see a deeper swoon for equity markets.
Is that a risk for you?
Base case,
Okay, it's not your base case, but how worried are you about that?
Yeah, so we would attribute a sort of 20% chance of that happening. In order for that to happen, you'd likely see a prolonged conflict in the Middle East. You'd see a spike in energy prices well north of $100 a barrel for a prolonged period of time, and significant impact on the consumer, but also on longer-term inflation expectations.
Mark Trevarthen, thank you so much for joining the business.
Thank you.